Trump says drop interest rates now on credit cards. Could it lead to a subprime catastrophe like it did in 2008? Hey, all this and more with a good friend and mortgage broker, Mr. Dion Beg, right after this. Here we are, my friends, back in a new year with our good friend and mortgage broker, Mr. Dion Beg. How you doing, my man?
Yeah, man, Gary, I'm very good. Holidays are always fun, but I always get this overdose of family. And now it's kind of like, I'm happy to be back at work.
Right. Back into the routine. As much as we say we hate routine, I think at the end of the day, we kind of like it. You know what I mean?
I think so.
Yeah. Here's the best thing about the new year. 2025 is done. It's over. It's behind us, my friends.
Done. Yeah, and I mean, that's assuming that 2026 will be better. So we'll certainly be talking about that today.
Absolutely. And there's all sorts of crazy news already. I mean, we're literally halfway through January already, believe it or not, my friends. And it's a lot of the same of what we've experienced for the last 12 plus months, right?
Depending on what you're talking about, there's also some unprecedented things going on in the world. but as it relates to real estate, yeah, look, still a bunch of properties for sale, sellers trying to hit numbers that are unreasonable, and buyers who are still sort of patiently waiting. And I think we'll probably look at some stats which show that there has been some downward movement in actual sale price, right?
Yeah, exactly. And just for fun, earlier today, I put in crazy Toronto real estate stats right into Google. And sure enough, the Gemini AI, Google AI, this is what it comes up with right away. We use the word crazy just for fun. So take that with a grain of salt, my friends. Price drops. Yes, we've seen the peak of February 2022, where the average price was 1.3 million. We know that down to basically $1 million. So it's come down substantial there. New construction plunge. New home sales in the GTA hit their weakest levels since the 1990s. I think that's we've all talked about that and experienced that. Inventory spikes. We have definitely seen that, and in fact, I don't have it right here in my hand, but I know we're sitting on average at about 3 to 4 months worth of inventory, which, on the big picture,
it doesn't sound terrible. Doesn't actually sound terrible.
However, that's a lot of inventory that hasn't sold over the last, even 24 months. Condo market woes. Well, that goes with new construction plunge and the interest rate impact. And I know you've got some insight here because it was a lot higher than what people were accustomed to. And as it slowly has been creeping down, and we've kind of held for the last, is it 2 rate announcements we've held, or is it one?
Yeah, I'm losing track, but we're stabilized for several meetings now. Yep.
Yeah. And you alluded to it. There's crazy, unprecedented things going on in the world, and especially to the south of the border. So, my friends, we're gonna talk about all this and more. We've got some interesting stats that we're gonna share with you, and maybe some anecdotes. And Dion, talk to us. Our Canadian dollar, our Canadian economy does okay on average. It's always just been okay. Typically a very safe environment because of how our banking situation here is. That's not quite the same in the States and what's happening right now with the Federal Reserve and everything like that. Let's kind of jump into that topic very briefly here.
So before one, this could be a boring topic for some, but I'm going to try and make it as interesting as possible and see how it applies to you and your world. So in Canada, we have the Bank of Canada and we have the Government of Canada. And they are supposed to be 2 separate entities where technically the government should not be influencing the Bank of Canada. The mirror of that in the United States is you have the US government administration, and then you have the Federal Reserve. And the Federal Reserve is like our Bank of Canada. They make decisions in particular about interest rates that then obviously impact the greater economy. And they're supposed to be making those decisions about interest rates purely based on their judgment of where the economy is and trying to balance things such as growth and unemployment and inflation, right? So the Bank of Canada, the US Federal Reserve, they're supposed to watch that independently and have done so supposedly for forever. Now, I say supposedly because maybe there's stuff that goes on in the back end that we're not aware of. But what is happening in the United States right now is that the Trump administration is leaning very hard on Jerome Powell, who is the federal chair, and they've been pushing him very hard, very openly for over a year, saying you need to drop interest rates, which in turn will boost the economy, which will allow the U.S. government debt to be renewed at lower interest rates, effectively saving the U.S. Economy, some money there. And Jerome Powell has been saying, well, we understand everything you're saying, but we have to do our job. And our job has nothing to do with the things that you're talking about to the Trump administration. What the Trump administration has done is now started to target Jerome Powell quite openly, and they're trying to find a reason to oust him from this position so that they can put in somebody else. And the reason that they've put forward is that there is some construction on a government building that Jerome Powell ultimately, I guess, signs off on at the end of the day. And they're saying that these construction costs have blown out beyond budget. And he knew that this was the case, and he didn't tell the truth about this. Okay. And I find this laughable coming from where the finger being pointed is from a man who works in development and no doubt understands how construction and renovations happen, quite intimately. So with all that said, the U.S. government is trying to push out the chair of the Federal Reserve so that they can put in their own man who will do what they want them to do inside that position. And it's effectively on world display. Now, it's laughable. If you were to ask me, would this be possible? I would say, hell no. But this is, again, a person who now calls himself the stand-in president of Venezuela right now. So who would have thought that was possible just 3 weeks ago? So I'm not taking anything off the table right now. I'm not going to say that this won't happen.
It's kind of mind-boggling, especially from the outside looking in. It's always easier to see, that to have that person kind of on your shoulder and look at all the different blind spots. And let me tell you, there's a lot of blind spots coming out of there. And here's the interesting piece, too.
Go ahead.
Jerome Powell, I just looked it up. The date that he became the Fed chair was February 5th, 2018. And you might not remember, but do you remember who inducted him, who awarded him or presented him with that role?
That would be Donald Trump, right?
That would be Donald Trump. That's right.
Yep.
Yeah.
Okay. So now he's trying to move him out. And I guess let me just sort of close the circle as it relates to Canadians. Okay. If this happens, if the federal chair is replaced by somebody who the U.S. administration wants in that position, the governor of the Federal Reserve would then be dropping interest rates, okay, in the United States. And short story is that what happens in the United States allows for the same to happen in Canada. So as crazy as all of this is, it may very well result in reduced interest rates. And I'm not actually saying that would be a good thing for the health of the Canadian economy, but it may be something that Canada needs to do due to other economic effects of the United States dropping their own interest rates.
Yeah, that is fair. I have a thought or a question, perhaps. Typically, when we've seen the reduction of interest rates, we typically see a bump in spending. And that's one of the reasons why they'll do that, not only from a consumer, but from a business perspective as well, right? The other thing that we've heard Trump say over the last couple of weeks to credit card owners is, hey, for the next 12 months or X amount of months, you need to cap the interest rate. So going from the high 20, let's say 28%, 29% down to 10%.
Oh, this I have not heard,
okay.
And I would be in full support of that.
Okay, so I have a question, though. The flip side of that is if that happens over the next, we'll call it, I think he's asking for 12 months, that those high interest rates drop it to 10%. Will the habitual spending still happen with the consumer? That's my question.
Yeah, it's funny now that I think this through into like the second order of things here, when things become cheaper, people then go out and spend more. So they're like, oh, wow, my credit card now costs me less, therefore I might go and spend double. Like unfortunately, there are people in the world who think that way. So that could also actually be an impact.
And as I think about it too, we all remember, or maybe you don't, back in 2006, 7, and 8 in the U.S. with the subprime mortgages, well, they were buying homes at an interest rate that was well below the typical standard, and it's almost the same analogy in a sense where those mortgages, that term came up, and that what was the word that they used? That interest rate.
I guess they called it was like an escalation.
Yes. Yeah.
Yep.
Anyways.
So I think if what you're saying is the proposal is for interest rates on credit cards to drop for 1 year, but then they'll just jack back up to the 25%, then yeah, what you're doing is unfortunately probably putting the most vulnerable and least educated as it comes to finance, into worse positions, because they likely will run up those credit cards thinking that those rates are cheap, and then forgetting about the fact that in a year they're going to have to deal with interest rates that are more than double.
Yeah. Interesting stuff. So, my friends, everything has a ripple effect, meaning what happens, as Dion said, what happens in the States ripples to here in some way of fashion or something like that. Okay, let's shift into the Toronto and Ontario market, and even Canada. We've all seen numbers come out, and I'm going to share my screen here, Dion. Treb Market Watch. This is the year over year, and as we finished out 2025, what I'm showing on screen here is in 2024 we had 67,000 homes sell on the Toronto Real Estate Board. That's resale homes. That doesn't include new construction or things like that. And you can see that we went from 67 down to 62,000. That's a decline to 7.7. And you mentioned this off camera. That's the lowest we've had in 25 years, Dion.
25 years. And actually, Gary, so we're benchmarking this off 2024, which shows 67,000. But what would you say is the average? Forget about the craziness of the COVID. But what would be the average transaction volume on Treb?
Yeah.
Was it more like 90,000?
Exactly. 90,000 is a perfect number for the number of sales at Toronto Real Estate Board. It supports our economy. Prices don't get crazy inflated, nor are they very reduced. So it's a happy market at 90,000 transactions. And
90,000. So we're basically 30,000 off the peak. So we're 30% off what normal would be.
Well, for us to get there now, we've got to sell another. We have to increase it. I'm struggling with the math. Is it 50%? Yeah.
Yeah, exactly. So we would need sales volume to jump by 50% this year to be back to normal 90,000 transactions per year numbers, right?
Yeah. And I would venture to say if that happens, we've got a hot real estate market and prices are climbing substantially when it increases that fast. So this isn't going to happen. Hopefully, this will not, and I don't see it happening. This isn't going to happen over 1 year. This will probably be another. If I were to venture and guess, yes, several years. I was going to say 5. It'll probably take about 4 or 5 years to get to that level again of number of sales. Which, if I think back to some of the economists that that I've listened to over the last 12 months, they're talking end of the decade. So that's 2030. That's another 4 years or more to get back to those numbers. And you can see the pricing there, the median price. And it's always good to look at the median price. That gets rid of those crazy outliers and things like that. We're down 8.6%. That's again year over year. And as I mentioned earlier, the high of 2022 was 1.3 million. In Toronto, and now it's down to that. Remember, that's average pricing. That's down to $1 million. I don't see that pricing. I don't know what you're hearing, Dion. I don't see that pricing increasing dramatically over the next 12 months or more.
No, I mean, I can tell you that so we obviously facilitate a lot of purchase transactions, and some of the purchase transactions. I'll give you a perfect example. In South Pickering. Older neighborhood, sort of 1960s constructions. You've got a lot of 3-bedroom bungalows and semi-detached. couple of years ago, these properties were selling for $1 million plus. One of my clients just purchased a legal duplex in South Pickering for $800,000, which is 20% off that number. Especially being legal, it probably was worth $1,050,000 or even more just 3 years ago. And so here we are 3 years later at a value of $800K. And so I feel like for those buyers who are working with real estate agents who know neighborhoods street by street, there are some pretty damn good deals out there. If you're a serious buyer right now, I would be engaging with your real estate agent and watching that market.
Yeah, and here's I'm gonna share an article here that you brought to my attention. This is from the Toronto Star, Dion, and here we go. This is the headline. This is your bit, so I'll let you walk us through this one.
Yeah. So look, I mean, this is a doom and gloom headline. So basically, this was written towards the end of 2020. Hang on, it was written. Okay, so it was published
January.
Okay, so published about 10, 11 days ago. And the message here is: list in the new year, sell by spring. Toronto area home prices are set to drop in 2026 and could wipe out 6 years of price gains. So pretty much in line with what I just discussed in that example of that Pickering property, Gary. That property was worth around $800,000 6 years ago. It jacked all the way up to 1 million plus, and now we're back down to $800,000 on that property.
This is what people will see, and is there truth to this? Well, here's when I sit down with buyers or sellers and they ask, well, should we list in the spring or should we wait till the spring? Should we wait till the summer to buy something? It all depends. But here's what I do share with them, Dion, is I know what the market is doing today. I don't know, although there's some indicators, I don't know what it's going to be doing in 3 months or 6 months or 12 months from now. But I do know what's happening today, and this is what's happening. If that's enough for you to make an educated decision after we go through some of the stats and maybe more importantly, the why and the where, then yes, we make a decision to go sell or purchase today. Based on this, if we already know, Dion, and I talked about it just briefly earlier, that we are at we have a very high number of homes that are for sale. The spring is only going to bring more homes.
Correct. Yes.
So that you can hear that in two different ways. If I'm a seller, I want to have less competition. If I'm a buyer, I want more opportunity to go purchase. So there's that fine line from where really you're from your point of view.
Yeah. And this one more thing I'll just say there is I've noticed, and you might have stats which we can bring up on another video, Gary, which is the gap between selling your townhouse and moving into the detached. That gap is significantly lower today than it was, say, 3 years ago. So we are seeing people who are in that sort of entry-level home saying now might be the time to transition into that second home because that gap, that jump up is a lot more manageable than it was maybe just 4 years ago.
Yeah, exactly. And we're also seeing less, we'll call them boomers, but I love our boomers because they're our parents, right? We're seeing that transition even come to a complete halt, meaning I got to sell my big family home that I've had for 30, 40 years and move into something maybe more manageable or smaller. We've talked about this, Dion. They're changing that house. They're renovating it to make it more accommodating to them as they age, and they're keeping that home. So that's less sales are happening based on that as well. And we know that generation is one of the largest generations or populations, I should say, around, right?
Correct. Yeah. I mean, they're living longer, they're healthy for longer. Therefore, they're not selling their homes or they're not passing away at age 75 like they used to 20 years ago. They're living there until age 90 and they're living there quite happily. So a lot of those properties won't be coming to market.
Yeah. There's lots going on, my friends. There's always some crazy news that we've got to deal with, Dion, almost on a day-to-day basis coming from the south of the border, if I could spit it out. And more importantly, you need to, as a buyer or seller, you need to really know what's going on locally to make really strong, educated decisions. And Dion, if people wanted to learn how to better finance or structure themselves, they don't have to be selling, but they can always do better financially in structuring and having those conversations. How do people get a hold of you?
Yeah, you can reach us at our website, kangamortgage.ca, or Instagram at the Dion Beg.
There you have it, my friends. That's, of course, Dion Beg. I'm Gary McGowan. We'll see everybody in the next episode. Goodbye for now.